We were talking about the Fed a couple of minutes ago. They've gone just extremely dovish, and I think dollar took a pretty hard knock. And if everything comes to pass, even more slowly as she goes in terms of this rate hike cycle, this seems to bode well if you believe this inverse correlation between dollar and gold is still intact. Do you?
I do, and I think what's more important, what drives the relationship, this inverse relationship, and there are two big drivers for gold. One is the love trade, which is a cultural affinity of Asia, the Middle East, India, and then there is this fear trade. And the dominant factor for fear trade are negative interest rates. So whenever a government has negative interest rates, gold rises in that country's currency because gold is the ultimate currency of the world. It's the fourth most liquid asset in the world. And when you want to have a currency like China wants to make it a global trading currency, it's been buying gold to support and back that. For special drawing rights, they only take gold. So I think it's key to look at gold as an asset class.
But here's the thing, the Chair Yellen, on this issue of negative rates, she was talking about that overnight, or rather was asked about it. She said, look, she's not going to go there unless and until it's really seriously exceptional circumstances. And that is the U.S., and that would be the dollar.
And that's for sure, but we're seeing gold was taking off last year in Australian dollars as the currency fell, in the Canadian dollars, so South African, and gold producers in those particular countries have had a fantastic move. And this year, with gold rising in dollar terms, the rise in the gold stocks has even been more significant and pronounced. So I do think we're in this gold cycle, and I think what's important, as I've mentioned before in your program, is that PMI, Purchasing Manufacturers Index, is a great precursor to look to the future over the next 6 months, and that data point is highly correlated to global economic activity, and global PMIs are negative. That is, the 1 month is below the 3 months. So that means rates are going to remain low. The probability of rates rising in the U.S. in July was only a couple of weeks ago a 50% probability. Now, to get at 50% probability, you have to go to February of 2017. The other thing that's important in the U.S. economy is discretionary. The discretionary sector is a key component of the overall S&P 500, and that sector is showing nothing but weakness, with the 50-day moving average declining. The concern that we're going to see in the fourth quarter inflation coming from rising salaries. And there's a concern that the $15 minimum, but more important is the overtime for anyone making less than $48,000 will create a margin compression. So these stocks have been trading down looking for inflation. So when I look at these headwinds, global PMI, the discretionary goods in America, the financial sector are still under pressure with all the regulations and rules and trying to digest them. And then this last little hiccup is Brexit. And what are the global ramifications to Brexit?